Hi everybody, and welcome back to video number 6 in chapter 6. And when we left off, we were looking at EBC borrowing $500,000 from Citizens Bank. The general terms of the loan are that EBC will continue to collect the accounts receivable. Citizens Bank assesses a finance charge of 1% of the accounts receivable and interest on the note at 12%. EBC makes monthly payments to the bank for all cash it collects on the receivables. The specific transactions are as follows. March 1, they enter into a loan agreement here with Citizens Bank. And then during March, EBC decreased accounts receivable by $450,000. $14,000 was due in sales returns. $440,000 was collected, less cash discounts of $6,000. On April 1, EBC remitted March collections plus accrued interest to the bank. During April, they collected a balance of accounts receivable less $2,000 written off as uncollectible. And then on May 1, they remitted the balance of $66,000 on the note plus interest on May 1. Complex little scenario here. What entries should EBC and Citizens Bank make for the above transactions? Well, on March 1, EBC is going to get the cash for $493,000. Interest expense is going to be 1% of $700,000, and notes payable is going to be $500,000. So to reduce the accounts payable, to reduce the accounts receivable for cash received, less sales discounts and sales returns and allowances during March, cash $434,000 less the $6,000, sales discounts the $6,000, and sales returns and allowances of $14,000. Total accounts receivable are going to be $454,000. So to record the issuance of the note to EBC, all the bank is going to do is issue a note receivable and a $7,000 interest revenue, the 1% of $700,000, which was here, and cash out of $493,000. Okay. Then on April 1, EBC is going to record interest expense, $500,000 for one month here, and notes payable, $434,000, cash, $434,000 plus $5,000 here. And then to record the collection in April of accounts receivable less the $2,000 written off as uncollectible. Here we're going to get the cash, $244,000, but we're going to debit the allowance for doubtful accounts to reflect the fact that we have written off the $2,000. And so our accounts receivable is going to go down by $246,000. And that's to remit the collections plus accrued interest to the bank on March 1 here. Oops, let's go back. And so over here, the bank is going to show that they're receiving this $439,000 in cash. Their interest revenue is going to go up by the $5,000, and notes receivable will be the difference at $434,000. Okay. Now, finally, EBC is going to remit the April collections plus accrued interest to the bank. And here we have the $66,000 times 12% times 1 month. Notes payable, going to go from 500,000 less the 434,000, leaving us with 66,000. The cash we're going to pay as EBC is $66,660. Now Citizens Bank is going to receive that cash, so we'll debit cash for $66,660. Interest revenue will be recorded as $660, and notes receivable will be $66,660. I think there's a little glitch there. I think that the notes receivable should be 66,000, not 66,660. I think that's a typo. Okay. Is it a sale or a borrowing? The FASB has concluded that a sale occurs only if the seller surrenders control of the receivables to the buyer. So we have to meet 3 conditions for that transfer to be considered a sale. Does the transferred asset isolated from the transferor? Has the transferee had a right to pledge or sell the assets? And does the transferor does not maintain control through a repurchase agreement? If all of those conditions are met, is there continuing involvement? If yes, we record it as a sale. We reduce receivables, we recognize the assets obtained and the liabilities incurred, and maybe we record a gain or loss. If no, if the continuing involvement is not there, then we're just going to reduce the receivables and record a gain or loss. Now, if it does not meet the 3 conditions, it's recorded as secured borrowing. We'll record it as a liability and record interest expense. So that's a little bit involved. And so here, what we're going to do is the presentation of receivables. We'll segregate the different types of receivables that a company possesses. Appropriately offset the valuation accounts against the proper receivable accounts. Number 3, we'll determine that the receivables classified in current assets section will be converted into cash within the year or operating cycle, whichever is longer. Number 4, we'll disclose any loss contingencies that exist on the receivables. Number 5, we'll disclose any receivables designated or pledged as collateral. And number 6, we'll disclose the nature of the credit risk inherent in those receivables. So here's PepsiCo, and you can see what they've done here. They've got cash and cash equivalents and accounts and notes receivable net, and pretty much disclosed receivables that way. Okay, footnote disclosures here. Now here, they have several couple of notes, significant accounting policies that they have here. You can read those on your own. You don't need me for that. And note number 15 here is supplemental financial information. So they separate the receivables into the type of receivables that they have. Here's trade receivables, other receivables, total receivables. They have an allowance beginning of the year, some amounts charged to expense, some deductions, some other. The allowance total at the end of the year, our net receivables then $7,822. And other assets here, non-current notes and accounts receivable, are spread out, the long-term receivables there. Okay, the decision analysis of receivables. Here, we're going to look at the receivable turnover. We use that to evaluate the liquidity of accounts receivable. And it measures the number of times, on average, a customer collects its receivables during the period. To me, that doesn't register with my mind terribly well, but it's very much related to the average days to collect receivable, which is really looked at carefully by me. And the general rule is that the average collection period should not greatly exceed the credit term period. So if the purchase order says 210 net 30, we don't want to see any receivables exceeding 30 days by much. Okay, so here's Best Buy. They reported net sales of 39,403,000. Its beginning and ending accounts receivable balances were 1,347,000 and 1,162,000, respectively. The illustration shows that the computation of the accounts receivable turnover and average days to collect receivables here. So what we do is we take net sales divided by the average net accounts receivable, and that's going to give us our accounts receivable turnover. Again, you can use the page out of the book. I don't want you to have to memorize the actual formulas for all of these. It's in the book. It's no problem using that on the exam. So in this case, it's 31.4 times, or every 11.6 days. Okay. All right. So let's look at some of the common techniques employed to control cash. In this case, management faces two problems in accounting for cash transactions: establishing proper controls to prevent any unauthorized transactions by officers or employees, or for that matter, anyone. And then, two, provide information necessary to properly manage cash on hand and cash transactions. So as we look at that, we're going to be using bank accounts to obtain the desired control objectives. A company can vary the number and location of banks and the types of accounts. And we have collection, float, lockbox accounts, which are very nice. If you don't know what those are, that means that the bank is collecting receivables for us instead of the customer sending those payments to us, and then we put it in a deposit and send it over to the bank. It goes directly to the bank. A great help in a bigger company. General checking account and impressed bank accounts. Let's take a look at those. To pay small amounts for miscellaneous expenses, we're going to set up an impressed fund, commonly called petty cash. And how we do that is we debit petty cash to increase it, credit cash to reduce our checking account to put that money in petty cash. And then when the petty cash custodian obtains signed receipts from each individual, then we're going to reimburse the petty cash fund as follows, right? The custodian is going to receive a company check to replenish the fund. It comes out of the checking account, not out of a petty cash account. So here's all our expenses that have been properly put through our petty cash fund, and our cash from the, not petty cash, but cash from our checking account. Okay, then they decide that the amount of cash in the petty cash fund is excessive by $50. It lowers its balance as follows, and we'll put the cash out of petty cash and back into the cash account. All right, that looks like a good place to stop our video, and when we return, we'll take a little bit more look at petty cash funds. Until that time, bye for now.